Welcome to this explainer. I am bringing my absolute best big sibling energy today because we are unpacking the ultimate blueprint to your financial future. Our goal in this session is simple, but it's ambitious, to help you reach the top 1% by exposing the hidden wealth killers that hold the vast majority of people back. If you're in your 20s or 30s, this is the foundational knowledge you absolutely need to start building real, lasting wealth. All right, so here's our blueprint for today's masterclass. We're going to cover the real truth about inflation, earning more while spending less, the math of compounding, mutual funds and their expense ratios, and finally, the market and the repo rate. Let's dive right in. Section 1, the real truth about inflation, the silent wealth killer. We're starting off by shattering the illusion of safety. So, 6%. That's the government's official inflation number, right? It's the standard rate you hear everyone talking about on the news. But here's the harsh truth we've just got to face. This broad percentage, it absolutely does not reflect your actual day-to-day life expenses. Because here is the reality. For the aspiring middle and upper middle class, real inflation actually hovers around 8 to 10%. And this is driven by massive compounding price hikes in the things that literally matter most to your future. We're talking high-quality education, private healthcare, and real estate. So, the crucial point here is that playing it quote-unquote safe is actually mathematically dangerous. If you're in a 30% tax bracket, keeping 1 crore in a standard bank savings account literally loses you 5.55% of your purchasing power every single year. Even a fixed deposit loses you a net 3%. Remember the whole samosa analogy? A samosa that used to cost $5 now costs 15 or 20. Its price is going up way faster than your bank savings are growing. By keeping your money idle, you are mathematically bleeding wealth. Section 2. Earn more, spend less. Building the wealth foundation. Before we even talk about the stock market, you have to systematically increase your earning capacity. First up, change your address. Moving to higher-paying cities or countries structurally changes your baseline income. Second, become a top-tier specialist. Find one domain and become an absolute A player in it. And third, focus on scaling that core income while strictly and partially avoiding high-risk traps like futures and options trading. You see it pushed all over social media, but mathematically, it just drains young people's wealth. Now, on the flip side of earning is spending. And I've got to ask you a really direct question. Are you spending for show? Honestly, are you letting peer pressure, social media, and lifestyle inflation from your friend circle dictate exactly where your hard-earned money goes? Because every day you face a crossroads. On one side, there's the FOMO trap, taking out personal loans for depreciating assets like expensive cars and flashy vacations, basically just to impress society. These loans act as literal chains, tying your future down. On the other side is the growth mindset. This means completely avoiding bad debt and quietly, consistently investing for 10 plus years. Seriously, stay away from the FOMO trap. Section 3. The math of compounding, the eighth wonder. Okay, to understand compounding quickly, you just need to memorize the rule of 72. This simple little rule is your absolute best friend for calculating exactly how fast your wealth will multiply. You just take 72, divide it by your annual interest rate, and boom, you know exactly how many years it'll take for your money to double. It's almost like magic. When we actually apply this in the real world, notice how increasing your return completely transforms your financial timeline. At a 7% interest rate, you are waiting 10 full years to double your money. If you optimize for a 10% return, well, that drops to 7.2 years. But if you can secure a 15% return, your money doubles in under 5 years. That is exactly how smart money accelerates. Section 4. Mutual funds and expense ratios, the hidden fees. Now that we know how to double our money, let's look at where to put it. Let's compare active mutual funds with passive index funds. Active funds boast high expense ratios because, well, they're paying fund managers to actively try and beat the market. Passive funds, on the other hand, have incredibly low expense ratios. They just simply and automatically track the top 50 companies, like the Nifty 50. For most of us with busy jobs, you just want a hands-off approach. These passive index funds are the ultimate stress-free heroes. And you know, the math becomes truly staggering when you stretch it over 5 years. On a 1 crore investment, that tiny fraction of a percentage point difference in the expense ratio becomes a total monster. A 0.71% active fund costs you over 5 lakhs in fees. Compare that to a mere 18,000 rupees in a 0.18% index fund. It's wild, right? Do not let those hidden fees eat your compounding snowball. Section 5. The Market and Repo Rate, Navigating the Macroeconomy. Finally, let's zoom out and meet the repo rate. This is the interest rate at which the Reserve Bank of India lends money to commercial banks. Basically, this single number acts as the steering wheel for the whole country, dictating the cost of all loans and controlling the overall heat of the economy. Here's the simple cause and effect. When the repo rate goes up, the economy cools down, your home loans get way more expensive, and consumer spending drops. But when the repo rate goes down, the economy heats up, loans get cheap, and business activity absolutely booms. This perfectly illustrates why stock markets tend to surge when the rate drops and why buying property gets so much harder when it goes up. Now, because these macroeconomic shifts are basically impossible to predict perfectly, here is your golden market rule. Never put all your money in at once at an all-time high. Consistent, long-term SIPs, systematic investment plans, will always beat trying to time the market. They are literally your ultimate shield against economic volatility. I want to leave you with this timeless piece of advice from Warren Buffett to really reflect on. He says, be fearful when others are greedy and greedy when others are fearful. So look around you. Is your peer group taking on debt for flashy lifestyles? Are they getting greedy? And more importantly, ask yourself, are you actively protecting your wealth using the blueprint we discussed today, or are you just blindly following the crowd? Make your choice and start building your legacy.